Hello and welcome to Unit 9. So capital structure and dividend policy over chapter 11 and chapter 13 and chapter 14, capital structure and leverage and dividends to and share repurchases, distributions to shareholders. So in this chapter we're going to talk about the optimal capital structure. So how does a firm decide what is the optimal capital structure? And we'll talk about business and financial risk, how to measure it with the Hamda equation, and the next chapter is dividend and capital gains and the residual dividend model. So let's begin. So a firm's optimal capital structure is basically the one that maximizes stock price. Okay, so it's a mix of debt, preferred stock, and common equity, which is the best way to maximize shareholder value basically, and the least cost in terms of cost. So they can finance it with stock, with equity, or basically preferred stock or debt. So when a business considers the four factors it'll consider when it makes those decisions are the business risk, and it'll look at its tax position and the financial flexibility it has, and the preferential what the management has, the different kinds of preferences. So business risk. So what is business risk? The business risk is exclusive to the business, that is inherent in the business power of the business without using any debt. So that does not include financing activities. So business risk is the risk whether the demand will be high, sales, it could be about the input prices, the output prices, about cost, products, and its operating leverage. So business risk is exclusive to the firm and inherent and part of doing the business. It depends on sales, competition, product demand, and operating leverage. So what is leverage? So leverage is simply the amount of fixed cost to the variable cost, and usually in heavy manufacturing industries or capital intensive industries the operating costs are the fixed costs are very high. So it is highly leveraged. That means it has to make that before it can make any profit. So to understand the leverage, you have to look at the operating leverage and the financial leverage. Operating leverage of the fixed costs will affect the firm's business risk, and the financial leverage is the amount of borrowing it is doing. So if your fixed costs are right here versus if the fixed costs are higher, obviously your break-even point is going to be higher. You have to cover the minimum base before you can make even any profit. So financial leverage is the use of debt to equity. So financial risk is the additional risk if the company takes on too much debt. Let us say it's 50% debt and now it decides to go finance with 30% more, it has 80% debt. So that puts a burden on the stockholders, because as they borrow more money, the cost of capital is going to go up, and the stockholders also bear that risk. So it increases two types of risk. Basically, it'll increase the financial risk and of course no creditor is going to issue without asking for more return. So the variability and uncertainty affects the earnings per share. So operating leverage, like I said, it's the firm's operating fixed cost relative to the variable cost. So high fixed cost increase the risk exposure. And some of the examples are your salaries that have to be paid, property taxes, and rent, which has to be paid whether you make money or not. So those are some examples. So that affects so if the debt increases, the firm's risk increases, and of course that increases the cost of debt. The required rate of return is going to be higher. So utilities, heavy manufacturing, auto manufacturing, high fixed costs basically. So those are risky businesses there. So but with the high operating leverage, you can also improve your profitability because you can use debt to your advantage. So here you have an income statement. Sales minus variable and fixed cost is your income minus the interest. Remember, interest is tax deductible, so companies can use that to their advantage and make more money for the stockholders, not pay more money in taxes. So if you have your sales of 1.5 million, you have fixed costs of 250, variable costs of 880, they make about 410, out of which they pay interest of 125,000. So the net income is 188,100. So if they did not have this 125,000, that would be added to the net income, and they'd pay more in taxes. So they use leverage effectively. But the question is, what is the optimal amount of debt that you have? So higher leverage means greater risk. Cost of capital would be more. So it's the one that maximizes the shareholder wealth and minimizes the cost. So Modigliani and Miller came up with a theory of what the capital structure does not matter, and they said markets are perfect, there aren't any bankruptcy costs, there isn't any brokerage costs, zero taxes. This they came up with in 1958, and all investors have perfect information, and earnings is not affected by the amount of use of debt. So that means we could finance our companies in perfect markets with 100% debt, but that is not true. So because that was highly criticized. So in 1963 they revised it for the taxes. They adjusted it, saying that all firms they revised it, saying the deductibility of interest favors the use of debt, and the more favorable tax treatment of income from stock lowers the required rate of returns on stocks, and thus it favors the equity financing. So the conclusion is still pretty much the same. So the Duke University professor John Graham says that that using debt improves their profitability by 7%, basically increases the firm's value by 7%. So if you cannot finance with 100% debt because the bankruptcy costs are high, liquidation problems, and customers will leave, financing is difficult to get. And the second is agency costs. That means they're keeping an eye. The shareholders will make sure there are bond covenants, and stockholders will elect and hire managers. So all of that increases the cost to the firm. So what effect does a firm have on the cost of equity? If debt increases, obviously the risk increases and higher required rate of return. So Hamda came up with an equation saying that the beta of an unlevered company times 1 minus the tax rate times plus times the debt to equity ratio. So his equation is take the unlevered beta 1 plus 1 minus the tax rate, whatever the tax rate is, times the debt to equity ratio, and that would be the levered beta. So that's how you compute that. So if you have 250 is your debt, 2000 is your equity, then you have 1 is your unlevered beta, so 1 plus, and 40% is the tax rate, so 1 minus the tax rate is 0.6. 1.06 times 250 divided by 1750, a percentage of debt that you have relative to the equity. So when you take your 1.08 beta, so your beta has gone up from 1 to 1.08. Now you multiply it with your risk-free rate plus the risk premium of 6% times 1.8. So now the levered beta increases because the debt increases risk. So it's just a way of computing the levered beta. So capital structure is simply how much debt and preferred stock and common equity we want. Okay, so a survey of 392 executives reveals that financial flexibility influences it, the credit rating influences it. If you have if you have insufficient internal funds, that could be another reason. Level of interest rates will also affect how much you want to the capital structure. Interest and tax savings, transaction costs, because issuing stock costs money. GM is going to issue new stock now to raise more money. Equity valuation, if a firm likes to issue debt versus, it depends, and on how the shares are valued or undervalued. So based on that, they have to decide whether you're going to use debt or equity, how the shares are perceived, and also on the competition. And bankruptcy costs are another thing, and of course customer and supplier discomfort. If high levels of debt will make them uncomfortable. So all of these are factors that'll influence the amount of debt that the company issues. So just like the Modigliani and Miller, the trade-off theory is another theory, and then we have the signaling theory that gives information how the company is doing when it wants to finance people. That affects the value of the company. So those are different theories. You might want to review that in chapter 13. And let's move on to chapter 14 now. So chapter 14 is about dividends and distributions. So obviously you invest in the stock so that of a company so that you get some return. So So you want to be paid either dividend or capital gains. So the companies usually the target payout ratio. Remember the Gordon growth model. So we use that. So Montgomery and Miller came up with the irrelevance theory. They said that it doesn't matter. Basically, the firm's basic earning power and the business risk determines how much the dividends the company is going to distribute. Basically, has no effect on whether the price of the firm's stock or cost of capital. So the dividend policy, it is irrelevant. So so that is what their theory is. So the other theory is some investors may prefer dividends and some investors may prefer capital gains depending on their investment objectives. So the clientele effect is some companies have to consider the kind of clients that they have. So the tendency of the firm will attract a particular set of investors. If they're seeking high cash income, they might invest in electric utilities with a payout ratio of 0.61% versus software industry which only paid 5%. So it depends on the type of clients the company attracts. So it has to look into that when it decides the dividend policy. So and what the taxes are for those investors. Some investors want dividends, some investors want the capital gains. So the residual dividend model is simply nothing but out of the retained earnings, how much do they decide to pay out in dividends. So dividends equals your net income minus whatever the equity ratio is times your capital budget. So if your capital budget is 800,000 and your target ratio is you want 40% debt and 60% equity, and you forecast a net income of 600,000. So how much of this are you going to distribute in dividends? You take the 600,000 minus the debt to equity ratio and the target equity ratio, and then multiply times the budget. So of the 800,000, 0.6 480,000 will be funded with equity. Okay, excess will be 600 minus the 480 is 120,000 is left as to be paid as dividends. So the dividend payout ratio is that excess left over. Out of that, the 20% is what you would pay. So dividend policy includes high or low dividends, stable or regular, or do you want to announce the policy? Some companies will pay dividends only if they make income. So the companies have to decide on what kind of a dividend policy they have. Some companies may want to reinvest their earnings and plow back so that they want to make sure that they earn more money. So you can have stock splits, you can have stock dividends. So that's another part of the chapter. So stock dividends are when you issue more stock. You issue 5% stock dividends. So the 100 shares will receive 5 more shares in stock dividend. The stock split is for every 1 share. It could be reverse split. For every 2 shares you can get 1 share, or for every 1 share you can get 2 shares. So you can have stock splits, and the idea is to lower the price of the stock or increase the price of the stock. So you can have stock splits or stock reverse stock splits. So the dividend irrelevance theory we talked about from Montgomery and Miller suggested that there's no relevance to it. So we calculated this one. How would a change in dividend affect dividends under the residual policy? Fewer good investments would lead to smaller capital budgets. Good investments would lead to a lower dividend payout. So the comments on dividend policy is it minimizes new stock issues, and it results in variable dividends, and increases risk. It doesn't appeal to any specific clientele. It just follow the payout and the target ratio. So consider the residual policy only when the long-term target policy, but don't follow it rigidly from year to year. And I did talk about stock splits and stock dividends. So the companies can do that. And we are not covering 14.7 and the repurchases in that section. Okay. So those are some ways the companies decide to set the dividend policy based on their clientele, based on the reinvestments, whether they want to reinvestment, the effect on the stock prices, and so on. Okay, so I'm going to conclude this chapter. You have another recording with the problems, so you can review that screencast also. Okay. So the summary of factors that affect the dividend policies are bond indentures. Preferred stock might have restrictions on them because they might say you cannot pay those dividends. So all those would affect. So basically, when you set your dividend policy, make sure you forecast your needs for over 5 years. Set a target capital structure. Estimate what your equity needs are,